Trump's tax legislation, temporary relief with long-term consequences. Rising Treasury yields signal fiscal unease. Tax law forecasted to shrink tax income by $4.5 trillion over 10 years. Anticipated impact on corporate profits and stock valuations. New York, July 3rd, Reuters. President Donald Trump's new tax cut and spending bill, passed by Congress on Thursday, provides a short-term safeguard against a default by the U.S. government, but deepens long-standing debt issues. Republican House members backed legislation that extends Trump's 2017 tax cuts, allocates additional funds for border security and military expenditures, implements significant cuts to Medicare and Medicaid, and increases the national debt by trillions. Trump is anticipated to sign this bill. The tax package also raises the U.S. government's borrowing ceiling, which was expected to reach its limit later this summer, to a new threshold, easing the risk of a U.S. debt default scenario. However, the long-term forecast for the U.S. bond market and the nation's financial stability remains relatively grim. It's predicted that the measure will add $3.4 trillion in debt over the next decade, raising alarms about the potential oversupply of U.S. Treasury bonds and the lower appetite for them in the financial markets. Such legislation highlights pressing concern over the structural issues facing treasuries, including persistent deficits, high debt levels, and inflation, explained Mike Medeiros, a macro strategist at Wellington Management. BlackRock has voiced concerns about increasing reluctance from international buyers in purchasing American debt. If this trend continues, the demand for the $500 billion in bonds issued weekly might diminish, resulting in escalating borrowing costs for the U.S. The precarious state of U.S. government debt has been a persistent point of contention. Without intervention, this debt could pose a serious threat to the special status of the U.S. within the financial markets, BlackRock's investment team mentioned in their latest report. The bill is forecasted to decrease tax revenue by $4.5 trillion, reduce federal spending by $1.2 trillion, and cause 10.9 million people to lose their health insurance over the next decade, according to Congressional Budget Office estimates. This legislation encourages economic momentum by letting businesses deduct equipment purchases and research investments, along with offering additional tax advantages. Despite these short-term benefits, some investors express concern that the government's debt might dampen the economic growth the bill aims to generate. Trump famously named the package the One Big Beautiful Bill. Campe Goodman, a fixed-income portfolio manager at Wellington Management, anticipates the bill might boost economic growth by as much as 0.5% next year. However, she thinks the market may be underestimating the long-term risk of higher borrowing costs. The One Big Beautiful Bill could fast-track corporate profit growth, ultimately impacting stock valuation, mentioned Ellen Hazen, chief market strategist at F.L. Putnam Investment Management. But this may enforce prolonged high Treasury rates, posing challenges for fixed-income investments in the future. The benchmark 10-year Treasury yields experienced an uptick on Wednesday, largely influenced by fiscal concerns. Yields typically climb when bond prices decline. Andrew Brenner, National Alliance Capital Markets head of international fixed income, indicates that Wednesday's market selling suggests that so-called bond vigilantes, investors who actively penalize poor economic policies, are observing the market closely. The vigilantes demand more deficit reduction. Their standpoint is that Trump and Congress have not undertaken sufficient action, he noted in an update to clients. Temporary debt relief? By increasing the U.S. borrowing limit, the bill mitigates the slim but critical threat of a debt default, which could severely impact global financial markets. Recent trends indicate that the interest rate on some Treasury bonds maturing in August has surpassed yields on short-term Treasury bills, signaling investor unease about the impending X-date. I believe the outcome of the bill might alleviate some of the debt ceiling worries, potentially reducing the yields on bills due in August, commented Vinnie Blue, Raymond James's director of fixed income capital markets in Memphis. Overall, the bond market's reaction to the bill passing remains relatively subdued. Market expectations had already accounted for expanded deficits following Trump's return to the White House earlier this year, with investor attention shifting toward economic growth prospects. Many participants agree that the bill's approval is secondary to other driving forces. The S&P 500 index closed at a record high on Wednesday, propelled by gains in technology shares and promising developments in U.S. trade agreements. Recent sluggish economic data has also strengthened expectations for Federal Reserve interest rate cuts this year, fueling optimism in both stock and bond markets. Conversely, a surge in jobs during a Thursday report slightly diminished hopes for immediate easing of the Federal Reserve's monetary policy. It's not the dominant market driver, stated Robert Pavlik, a senior portfolio manager at Dakota Wealth in Fairfield, Connecticut. It's all about earnings first, followed by the Federal Reserve, he added.